Stuart. It's been a while since we've got to reconnect, which just means that there's a lot of new information for me and my audience to learn from you. So thank you so much for being here. Why don't you start off by introducing yourself for the audience?
Sure. So my name is Stuart Gelb. I believe that I am a commercial finance expert, and my niche is really solution driven, right? We're just not about going out to get a person a term sheet. No, we want to understand completely the challenges of the client, what they're facing, what they've seen in the past, and what do they need to make this deal good, very good and very strong.
So, one of the reasons why I wanted to have this chat today was because in this podcast, we really talk a lot about health, wellness, well being, not only of people, but also buildings, and also the businesses that run those buildings, the portfolios, the office workflows, the data optimization. And in this case, we really want to understand the health of some of the capital stacks and the debt stacks that are behind a lot of these buildings, these portfolios. What is the current state of this market? And we'll get to some of what are those solutions? What are those opportunities? Of course, that's what you do best. So we'll get to that a little bit later in the episode. But I would love to start just by painting a picture of where we're at right now. And for those of you who haven't watched any of the videos we've done with Stuart on commercial real estate financing over the years, they're on our YouTube channel. So I encourage you to go watch over the years and maybe reference how they've changed from this conversation. So please take it away.
All right, so let's start with a couple of things, like what's been going on actually the last couple of years as a starting point and what's going on today. So some of the challenge that faced, and they didn't even know it was a challenge at the time. Imagine you were a developer a year and a half, or 2 years ago, had a great development idea, ready to purchase the land, had your pro formas made up, but the pro forma on getting the construction loan might have been 4 and 5% for the construction loan. For today, it's 9%. And the pro forma on your permanent loan, in other words, when you get ready to perm out the loan, you probably would have had it done. I mean, it was as little as 3.5%. We used to get deals done at 3.5% or 4%. Today, it's at least in the low 6s on the perm. So basically, a lot of the challenges some of the people are facing, a lot of them are facing, is that they'll never be able to perm out at a number that's probably going to make the loan good, right? They're going to need more equity. Something's going to change because the cost factors has changed. And on top of that, not to get too much into the weeds, they have an item called debt service coverage ratio that they've been raising from like 125 to 135, which decreases the loan that they can actually give you. So if you think about a loan that you had put in your pro forma that you were going to get $20 million, for example, well, when the rates went from 4 to 6 and the debt service went from 125 to 135, the $20 million loan might be 16. So that's changed radically. And that was never figured in. It was a pro forma based on what they knew from the years in the past and how it should be going forward. So that's challenge one. The next challenge is even going to the bank today, for whatever the reasons are, which is basically cost of funds. Rates can come down, and they are coming down. But what we're finding, even it would be on permanent financing, what we're finding is a bank may say to you, we typically lend at Treasury plus a number, right? So the 5-year Treasury is 380, and they put down 2%, they would loan at 580. So what they're doing now, because cost of funds are high. So think of this, 2 years ago, you went into a bank, you left a couple $1 million in the bank, and they were giving you somewhere between 0 and 25 basis points on the income side, right? They were giving nothing. And today, it's costing them 4% for CDs and different things that they had to give people additional money for, which raised the cost of funds. The COF raised those up. So even though they would like to lend the money at 5.5 or 5.75 or even lower, they can't because their cost, it would be like in any business, like cost of goods sold, is too high. So imagine when they were giving 25 basis points and lending at 3.5, they were making 17 times cost. And now if they have a loan that they want to do at 5.25 or 5.5, if it's costing them 3.5 or 4, they cannot. So what they're doing is they're giving you a structure that they're going to work with, but then they're going to give you a flat minimum that they're going to charge you. So they could say 5.85, but understand that the loan's going to cost you a minimum of 6.5 or 6.25. That'll be in the same term sheet. So right away, the costs are higher. So that's the beginning challenges of what's going on. And then on top of that, if that wasn't a challenge tonight, almost every bank, some of them are not even doing construction anymore, or they're doing much less of it, or they're doing it only with the historical customers that they did great with, and some of them are very lean on the construction loans to begin with. They're really uncertain. So it's not so easy to get those loans done with the banks. So these are the immediate issues. And then on top of everything else, some of the banks, I would say most of the banks, regional banks, want 10 to 15% deposit, not as collateral, just as a deposit, because they want to make sure they have money in the bank. If you remember the last couple of years when money was pulled out of the banks to go to different banks for higher income, they want to protect themselves on the deposit level. So imagine if you were doing a $20 million loan and the bank said, okay, fine, we're going to do the deal, but you got to leave $3 million. That would be 15%. Or if it was 10%, it would be $2 million. Well, there's a lot of big guys that have a lot of money, right? So they may have the money to put it into these banks, but they're going to be putting it in all the banks they're doing business with. And there's a lot of the people that cannot afford it, or a lot of developers that usually, if you looked at their financials, they could have $100 million in real estate and $200,000 in cash in their account. They're always working the money, working the things to their best. So they're not usually in a high cash status at the time of doing loans. And that's more of a problem today than it ever was. So there's definitely solutions, and the solutions that we're going to talk about on the healthy capital stack, which really more or is done with very large people in the construction business. They were doing $50 million loans or $100 million loans and not using so much of their own equity. Now we have that challenge. Well, how can I do a deal at a bank, even on a $10 million loan, where they've dropped the loan to value, which they call LTV, to 55%, say, instead of 65. So the most the bank's going to give you is $5.5 million. At the same time, that $10 million loan, they're going to want 10 to 15% deposit, which is $1 million to $1.5 million in deposit. So they're giving you less money, a bigger loan, and now you can have in a deal for $10 million, $4.5 million for the equity need, and $1.5 million for the deposit need. You need $6 million to do a $10 million loan. That's a challenge. So I'm the first.
Do you think that this is deterring a lot of people from entering this industry to begin with? Forget about the people who are trying to do business as usual. This sounds like it's almost a lost cause for somebody who would be considering a career in development, in real estate investment. It seems impossible.
It does, but like so many things in life, right? You come up, like, you think about what it was, and then you think about what the challenge is. And I think the person that's aggressive, and that's what we're going to talk about today, how can we do this and still make it a really successful by taking into consideration what the banks really want and what can we do to get there, right? Because that's always something in life, right? It's not always the easy way, but how do we find those challenges? And maybe for some people, it's just taking an equity partner, just taking a partner in. You know, the deal's so good, not passing on the deal. Let me put it, but the problem or the challenge there is you don't want to pay so much for equity, right? So if you have to go to somebody for equity, they may want even a bigger piece than you in order to do business because they know that you're really in need, right? So I think that we have solutions to that, which are really good. I think that's what we're going to be talking about today.
Yeah, let's talk about it. Let's get into it. And I think also those really good deals, do you see more of a challenge in sourcing what those really good deals these days? Because then I imagine you go to an equity partner and it's more than just, oh, they want more equity, because they see how desperate you are. It's also, thanks for finding this great deal. I want the majority equity stake. Here's your referral fee type of thing, right? So do you see that the deals are harder to find, those good deals that line up with, attractive equity and loan potential?
So I think this is what it is. It's like a lot of things in life. First of all, you're not going to get involved typically with anybody that's not successful at what they do. So the same way the banks look at it, the bank looks at it and says, this guy wants a loan on a hotel. Okay, but when we looked at his resumes, he did 10 multifamily. We're not giving him money for a hotel. We want the guy that had 10 deals and they've all been really good. And that's why we're doing business with him. So I say the guy that's an investor or an equity player with the guy wants to make sure that the guy that they're working with has had a lot of success. So that's a given. The other thing that's a given is property type. Like, for example, one of the strongest property types today is multifamily. Now, it's not necessarily great in every city and every state. But let's take Long Island, for example. Long Island, it takes 3 or 4 years to get permits done. The townships are crazy. It's so hard to get something done. So the guys that are able to get it done and do get it done are building these places, they're renting them right away, and the rents continue to go up because there's a shortage of inventory. It's like the housing market. In most parts of the country, yes, the rates may have come down a little bit, but why are the prices going up? Inventory. With lack of inventory, prices rise. When you have a lot of inventory, people have a lot of choices, prices go down. So I think the property type is very important. Like, it's very difficult to get a bank to do an office deal. Are there some being done? Yes, but very, very few. It's got to be like a very strong, and maybe a guy that's in the medical space, or he brought in Northwell, or he brought in somebody that signed a 15-year lease, and they're getting the office, and they're getting the office prices lessened because of the problems that are going on in the market in the office. I heard reports last week where buildings of office in New York City is running like $1,000 a foot, and some of them are being sold for $450 a foot. So you can imagine it's a disaster at
That's
the office
crazy.
level. So I think the property type is important. The person that's doing the deal is important. The pro forma that they're showing the deal, to their equity partners or potential equity partners is important. And how they've done over time, their resume and how strong they are makes the deal worthwhile.
So let's talk about some of the solutions because it sounds like just like any entrepreneur or any business person, it's going to take a little bit of creativity, but the solutions and opportunities are still there. So talk to us about what you're seeing from an opportunity
Okay,
standpoint.
so I'd like to start out with what we've been seeing when it came to healthy capital stacks and who it was originally made for, and then talk about what the smaller guy, when I don't mean smaller, but the size of the deals, how he could take advantage with something similar to what the bigger guys were doing and doing well. So when
So
you would
you
see
think
large,
you think that there are opportunities now that exist that maybe didn't exist for smaller players to mimic some of the actions of those larger players traditionally?
100%, because
That's
up
awesome.
till lately, you would get a 65% loan to value on the property from the bank, and you have to come up with 35% equity. And whether it was you alone or you had a partner, whatever it was, that was the deal, and there was no deposit needed. So if you can imagine that, 65%, okay, they had to come up with 3.5 million between either him and the guys, whatever it was. And today, that same guy, if the LTV is 55%, he needs 4.5 million. If he needs 15% of the deposit, he may need 6 million. So think 3.5 versus 6 million on the same size deal. That's the challenge. So I think we first talk about why the capital stacks exist for the larger guys and what they were able to accomplish, and then chime in what the guy that's a little bit smaller could do to be creative and be somewhere in that wheelhouse and get a deal done similar to the way the larger guys have done it.
Excellent.
So let's start out. So a capital stack is typically made up of the senior note, which is typically the bank, whether it's 55% or 65%. That's typically the best deal of as far as the rate and everything, right? They may be getting 8.5% or 9% right now, but that's that they have the lowest amount of risk. And if the project defaults, the bank's in first position and they would take the property. So if they put up 65% and there was a default to taking the property's going to, and the place is going to be worth more than what they put in. They're going to be in the safest spot. The next potential piece is what they call mezzanine debt, which is fairly expensive. It could be 10 to 15%, but it's non-dilutive, so you're not really giving away any equity. And if you had, for example, a deal that was, let's say $20 million, and well, in these deals they should be higher. I'll show you the large ones later. But if you had a $20 million deal at 55%, you need 11 million. Then on the $20 million deal, you may need $3 million for the bank for the deposit. So you have to come up with too much equity. So on the mezzanine debt, you may say to yourself, "Oh, I know what I'll do. I'll put in 10% or 15% of mezz, which is really a bridge loan on top of the senior note. You have the senior note, and then you have the mezz note. So that is subordinate to the senior note. And then once the developer pays off all their operating expenses, they have a coupon that they have to pay for the mezz money, right? So, and then there's an intercredit agreement they have to do with the bank, because the bank wants to make sure if there's a mezz guy there that they can count on him. If the deal falls apart, that mezz guy can probably build the structure. They don't have to worry about somebody just walking away. So that's very important. But the mezz piece can help, or does help, especially the larger guy in the past, to bridge the loan. So again, to reduce the amount of equity that's needed. Behind that mezz piece is a chance to do what they call preferred equity, it can be very flexible. It can also be a hard preferred, which is a little more intense, where they have coupons and different things like with the agreements that makes it harder. Or there could be a soft preferred equity where they're saying, "Okay, I'll tell you what. You put in the money as a bridge. We'll give you, let's say, 8%. We're not giving you any of the 8% until we stabilize. So in 2 years, if it was a multifamily and now you stabilize, the income's coming in, now you're ready to do a permanent loan. So at that point, you'll give him his 8% plus 8%. If they put in $2 million or $3 million, it may be $320,000 or $500,000, but that won't be given until they do the perm out, and now they have the additional money from the funds, the perm out. So it's not a really costly piece for that owner, but again, as a bridge, it lessens the amount of equity he has to put in. So if it was a $20 million deal and the bank was only giving it an 11, if you got $3 million from the mezz and $3 million from the pref, you're already up to 17 million of the 20, right? So now there's only 3 million left. So now what can you do? Well, you could take in you could have common equity, which is like an LP, limited partner. And then you have the GP, the general partner. So if you got $1 million or $2 million from the common equity, you only may have $1 million in the deal. The issue, and it's a little intense at that point, because on the smaller deals, at least up to this point, they're going to let you have some variations, which we'll point out, to bridge, but they're going to want more equity from the general partner. On the bigger deals, which I'll show you, I have a deal that I looked at, let's say it was $100 million in financing. So the senior note would be 55%. They come up with $55 million for the bank. The mezz guy, maybe 15%, so now they have $15 million from the mezz. The preferred guy, they have, let's say, another $15 million. So they have 55, 15, and 15. They got $85 million into the deal. And then they get the common guy to put up 10, so it's 95. And that big guy, the guy that's like the strength. He only put $5 million into the deal. Of course, the numbers have to work. You just can't be paying out, these levels, but it's got to be a great deal that the bank understands it's going to work, and they have the intercredit agreement, and they know the bank has to know they're not going to get hurt. And a lot of these big guys that you see doing these big deals are doing exactly what I'm explaining. So this is the way that they work. So now I'm taking into effect, wow, this is pretty cool, right? This is something that, how can we get the little guy to do something similar and not worry about all the equity that he's got to put in, or doesn't want to give too much equity away so that the deal still makes sense for him. So let's try that one out for an example. Guy has a $10 million construction loan. And maybe the banks at $10 million says, you know what? I don't want a mezz guy there. I don't need a mezz guy. I'm not going to worry about an intercredit agreement. It's not for me. Okay, fine. So on the $10 million deal, the bank wants, let's say, we'll give 55%, it's $5.5 million. So maybe the guy, depending on what his needs are, and remember, on the $10 million, he probably has to come up with $1 million or $1.5 million of deposit too. So now he says to himself, okay, you know what? I know some guys that I can get pref from. Let's say 3 million, for example. Just use that number. 3 million. I'll give the guy 8%, but I'm not going to get a year, but I'm not giving him that until I perm out. So on the 3 million, they would make $3 million would make $240,000 a year at 8%, right? So for 2 years, it would cost this guy $480,000, but he'll have the perm money. If he's going to make a lot of money on the project, if the project that he is constructing for 10 million is going to be worth 22 million or whatever it is on a perm, he'll easily be able to pay that to the guy at that point. But what he's done for himself is he took a $5.5 million need from the bank. He took $3 million from the preferred equities, 8.5. He only needs $1.5 million for himself. And if he needs another million or $1.5 million for the deposit, now he only needs $2.5 or $3 million for his deal versus 4.5 and 1.5, which is $6 million. So look what he accomplished. He has a deal that's workable. Yes. Is he going to give some equity away? Yes. But typically what happens on the preferred is they give like a 60-40 split. So if the guy was putting in 50% equity and he got 60%, he would only get 30% equity instead of 50 on a 60-40 split. The GP guy would keep the 40. And then there's other things which I don't really want to go into the weeds, but they have things like hurdles and waterfalls and things like that. And those treatments are, look, if I'm able to maintain a 8% IRR at the end or a 10% IRR, I get a bump up in the income. There's all ways for these guys to work out deals so they could be sweeter for the GP at the end, at the same time conserving his cash, which I think is probably one of the most important things, especially for the smaller guy. And this really gives him a chance to do it as long as the numbers work. So I think that's the edge. We're like copying the large guy and working around a certain way so that we can address what the person's needs at a lower level is.
It sounds like you're quite optimistic about what opportunities exist right now that may not have even existed, or people may not have been trying to maneuver before. Is that the case?
I think so. It's funny. It was only this morning that I had a breakfast with a guy that's an attorney and does a lot of construction, and I talked about the healthy capital stack. He said, "You know what? We really never thought about that, but I have to tell you, for the smaller guy, well, I don't mean smaller that he's whatever, but in the concept of the money that he has,
No, in our
this is
industry.
it's a great way for him to get around it a bit, and I think the banks would be fine with it." So
So it sounds like
I think the opportunity also lies, of course, in the property type, what the pro forma looks like, and understand the banks don't just give you the money because you just give them a great pro forma. They go out and they check the comps on the rents at that point. They check the comps on construction. You just can't put in numbers that don't fit from the appraisal level. So the banks know pretty much whether it's a great deal or not. And I think there's always an opportunity, and one of the challenges is the funding process. And I think this brings a lot to this conversation.
What would you say to some of the younger folks who are even, in college in New York, learning about investing and learning probably about some of the more traditional methods that may not even be super relevant today? Do you think that there is an opportunity for them to enter into this space with confidence?
100%. I think you're taking, look, back in the day, there was a time in the 80s where rates were 17, 18%. People were able to deal with it. There's always a challenge. There's always a change. Nothing's ever the same. So it's really like, this is what's going on today, and what do I do to address it? And can I be successful at something by understanding what I have to do to make that success? Right? So if you needed $6.5 million to do a $10 million deal, I don't think that's something you would do. But if I could figure out a way to get a friend to put in the preferred equity or get those deals done and the numbers are really good, sure, why not? And I think the people anyway that first go into the business from college to real time really need to work in the environment for a couple of years to get a little bit seasoned at what they do. It's not a place for someone to say, "Oh, I love this. I think I'll put money, even if I had the money, I think I'll put money in now and see how it's going to go." I think you really need to be seasoned so you can experience what it really is to be in that space. And even by that time, things may change.
Right.
A couple of years, maybe rates that are 6 are now 4.5. I mean, they're not going to be 3 or 2. And maybe there won't be deposits. We don't know where it all goes, but there's always an opportunity.
So do you think that the climate for lending is changing more rapidly than it has in the past?
I think there was an immediate freak out and when all of a sudden rates went crazy and banks started putting a brake on everything. But interestingly enough, the last few days I've been reaching out to some of the bankers and they're ready to do business again. Yes, it's not the same rate, but they're not shying away where I would call the guy that I called last week said, yeah, we're going to do $10 million construction loans as long as they have the resume in place. Where if I would have called them 3 months ago, they may say, we're not doing any. So
Right.
they're starting to breathe their guard down a bit and they're bringing some of the rates down a little bit. And they know that in the end of the day, they feel better about what's going on and they're ready to make some adjustments to how they felt a few months back. You
I'm
can
so
kind of
happy
see.
to be talking about this. I really am because I think that especially if you're not working directly in this field and you're not a steward, on the phone with the bankers every few days and really understanding this environment from a day to day basis, it's so easy to get caught up in the media and feel
Yes.
like things are more doom and gloom and this industry is going down the tubes and all of this crazy stuff that is big sweeping generalizations and very little context and very little understanding of the nuance that really exists. And also history and context and all of these factors that exist. So I think it's so refreshing to chat with you, and I'm so excited to share this episode with my audience. And I hope that some of the younger folks even really open their eyes to the fact that a lot in doing business in commercial real estate hasn't changed. It's all about getting creative and having tenacity and, consistency and fortitude and finding a way to find your success, like you said so eloquently. So I really appreciate this conversation so much.
That's great. And one more thing I'd like to enter that,
Please.
like they'll go to a bank and these banks will have the higher rates and very strict prepayment penalties. And it's hard for them to get out of the deal without paying a fortune of money.
Right.
And I've been able to negotiate with a number of the banks to get out of the prepayment penalties. They don't even think about asking. So there's always a way, there's always a challenge, and you have to work with people and also shop a lot of places. It's not like your friend Joe was the banker and you knew him for 10 years and everything's fine. Joe may be the highest guy in the market, right? It's not like you're waiting for Joe to make the thing. You got to find out.
Right. And so we will, we will include some of your contact information in the description of the episode. So if anybody does want to get in touch with Stuart to help them shop around or just understand this situation a little bit better, he's a wealth of knowledge. So I encourage you to connect with him, whether it's on LinkedIn or have a conversation with him. Certainly, if you're in the New York area, I maybe have a cup of coffee with him on my behalf because I'm not there anymore to do so. But I just want to say again,
I'd like to help anybody. They can always give me a call. There's no charge. Just pick up the phone and call.
I know you do. Yeah, I know you're always willing. So I really appreciate that. And you just have some really great basis for knowledge and also foundation for optimism, which I find is so rare in this industry. I think that working in this industry, even for as long as I have, which is not, so long, 10 years, it's very easy to, it's easy for that optimism to diminish to some extent. And you go through these cycles and you see, how things play out. And I really appreciate somebody who, can be optimistic and just really push the narrative of keep being creative, keep finding the success that works for you and the situation that works for you. So I do appreciate that once again. And I'll look forward to speaking to you again very soon, Stuart. Thank you so much.
Thank you.